Hey everyone, Matt here with Market Digest. Today I'm just going to be going over some mistakes that investors make when looking for dividend paying stocks and how you can avoid some of these mistakes. So the first mistake that a lot of investors make when looking for a good dividend paying stock is that they don't look at the actual dividend history of that company. The website that I use to look at a company's dividend history is nasdaq.com. They're a really good website to use. You can go up here, type in any symbol, and you can find the dividend history of that actual stock. For this example, we're going to be using Apple, and as you can see here, it shows the dividend yield, which is the percentage of the actual stock price that you get paid in dividends every year, and then it shows you that amount right here, and then it also shows you the payout ratio, which is the ratio of their earnings that is actually paid out in dividends. So as you can see down here, it shows you the history, and some things to look out for when you're looking at the history is whether they've missed any payments or if they've increased the dividend price or the dividend amount over the years. So as you can see here, Apple started paying dividends in 1988. Wow, that was a long time ago. And they started at 10 cents a share and increased it to 12 cents a share, and then they stopped paying in 95. And then in 2012, they started back up and paid $2.65 a share, and then have been increasing. And then down here you can see in 2014 they actually cut the dividend from $3.29 a share to 47 cents a share. So these are definitely things to look out for. And also another thing to look out for is whether they've actually paid all of their dividends. Usually a company pays dividends quarterly, although you can find dividend companies that pay monthly or annually or semi-annually. Most of them pay quarterly, such as Apple here. So to check if they've actually paid all their dividends, you can just look at the years and see if it's shown 4 times. So 2019 showed 4 times, that means they've paid all their dividends in 2019. 2018 shown 4 times, so you can see that they paid all their dividends that year as well. And you can just scroll down here and see if the year is shown 4 times. If they pay quarterly and it's shown 4 times, then they've paid all their dividends. This is definitely something really important to look at when you're picking a dividend stock for your investment portfolio. A lot of people don't actually look at the dividend history, and it's really important and can help you determine whether a stock is actually going to be solid and safe for the future in terms of paying its dividend, or if it's a stock that is a little bit more risky in terms of paying its dividend, whether it's missed payments or is decreasing its dividend amount or not consistently paying the same amount. Another mistake that a lot of investors make when looking for a stock that pays dividends is that they try to find the company that has the highest dividend yield. For this example, we're going to be using Ford Motor Company. I actually like Ford Motor Company, but it has been in a downtrend over the last 5 years, so this is the point I'm trying to get to. Usually companies with high dividend yields are actually companies that are not that great, that have been going down in their underlying stock price over the last however many years they've been increasing their dividends. And this is what you have to look out for. When they have a high dividend yield, usually it's because they want to attract investors because their financials or their other statements are not that attractive themselves. The whole point of a company issuing a dividend is so they can attract more investors to buy their stock because they want people to buy their stock. And when a company has a dividend as high as this one says, 11.45%, although I don't think this is Ford's actual dividend yield, sometimes Google shows it a little higher than it actually is. I think it's around 8.5%. But either way, when a company has this high percent of a dividend yield, it usually means there's something wrong with their underlying financials, and that's something to definitely look out for, as well as their share price. Usually with companies having this high of a dividend yield, their stock price has actually been decreasing over time. And this is something to keep in mind because when you're buying the stock, you're not just looking at the dividends that you're going to be getting, you're looking at the actual share price too. So if we look at Apple over here, they have a smaller dividend yield of 1.06, but their share price has been increasing greatly over the past 5 years compared to Ford. Over the last 5 years, you would have made more money with Apple simply because their share price increased more than the difference between the dividends of the two. So in a lot of cases, the company with the highest dividend yield is not actually the best. And dividend yields that I tend to look for when I buy a stock for its dividends are usually around the 4 to 6 or 4 to 7% range. Anything higher than 7% range, as a rule of thumb, is usually not a good company to invest in because they're going to be going down over time in their actual stock price, which will actually potentially cancel out all the dividend gains you would have made from that company. So there would be no point in buying that company for its dividends since they'll all be wiped out. The third mistake that I see a lot of investors make is they'll try to do dividend capturing. What's dividend capturing? Well, first, let me explain what an ex-dividend date is. The ex-dividend date is the date you need to own the stock to actually get paid the dividend. So if you own the stock before the ex-dividend date, you'll actually get paid that dividend. So what a lot of people like to do, and this is referred to as dividend capturing, is that they'll buy the stock the day before the ex-dividend date and then sell on the ex-dividend date, and that way they get the dividend while selling the stock, so they don't really have to own the stock. And at first, this sounds like a no-brainer. It sounds like you're making profit with absolutely no downside. Why wouldn't everyone do this? Well, it's not as simple as that. A lot of investors know about the ex-dividend date, and so the stock price actually adjusts around the ex-dividend date. So say you bought the stock before the ex-dividend date, and then you sold the day after. Usually, whatever amount you would have made in dividends, the stock price will adjust to that. So let's say you bought Apple, and then you were going to sell it on the after the ex-dividend date, and you were planning on making $1.50 in dividends, right? Well, the stock price would actually adjust $1.50 for those dividends, so you actually will just break even. Now, it is a strategy and people do use it, but in most all cases, this is not profitable, and you'll really just break even, if not lose money, based on whether your brokerage charges a commission or not, or the small fees that you have to pay in between. So it really isn't worth it, and I see a lot of people trying to do this. I'll link an article down below in the description on dividend capturing and how to do it properly if you're interested in that. But it really is not a good way to make money. If it was, everyone would be doing it. So there's that. So definitely, if you're going to buy a stock for dividends, you want to hold it for the long term. That's why you want to look at the dividend history and stuff like that. And the last mistake that I see a lot of investors making is that they don't diversify their dividend portfolio. Now me, I'm not a huge fan of diversification in general. I usually think that if you're going to buy a company, you should believe in it enough to allocate a good amount of your portfolio to it. But with dividends, it's a little bit different because take, for example, right now with the virus going around and everything, a lot of companies are actually canceling or cutting their dividends. So if you just had all your money in one or two dividend stocks, there's a good chance that you might not be getting dividends anymore. So it's really good to diversify your dividend investment portfolio. Probably 5 to 15 dividend stocks is probably what you want, all in different sectors, all having a little something different about them. That way, if one particular sector is hit hard by something like this virus, the others will carry and give you your dividends when you need them the most. For example, Ford right now actually cut its dividend, or actually I don't think they're paying their dividend, while for example another company such as AT&T is still paying their dividend. So that's why it's good to diversify with dividend stocks, especially because sometimes they'll do these cuts or cancellations of their dividends and you might not hear about it. So it's really good to have this diversification in this kind of portfolio because you want to be protected from potential missed dividends. So I hope you found some of this information helpful. Leave a like if you did and subscribe for more finance, investing, and economic content. And leave a comment down below of any advice you have for others on dividends and stuff you generally have noticed to avoid because there's a lot of mistakes out there, probably a lot I didn't cover in this video. So if you could help other people out, that'd be awesome. Thanks for watching. See you guys in the next video.